Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room, live streaming in YouTube. We have some economic news that came out this morning. Unemployment claims higher than expected at 419,000 new claims. We're going to take a look at the market effect on this news, and also we'll take a look at gold, silver, and Bitcoin as we come back here. Welcome, everybody. Let's take a look right away into the unexpected jobless claims hit a 2-month high. Continuing claims fall. The number of Americans filing new claims for jobless benefits rose to a 2-month high last week, with a reminder that the labor market was far from being out of the woods as the nation confronts a resurgence in new COVID-19 infections. My mouth is a bit tight this morning here. Still, the weekly jobless claims report from the Labor Department on Thursday showed more people are returning to work, a trend that bodes well for July's employment report. The rise in jobless claims this week tells us that the labor market troubles are not completely behind us, and with the Delta variant may throw a monkey wrench into the economic recovery from the shortest recession in American history, said Christopher Rupke, chief economist at FWD Bonds in New York. I wanted to take a look here at what the report was saying here, basically. And one of the things that stood out for me was this paragraph here that says, though economists do not expect large-scale businesses shutdowns, the latest wave of infections poses a risk to the economy, which experienced a sharp 2-month recession in 2020 due to the pandemic. Now, when they're saying, that potentially they can expect, I believe that this is more likely to happen, as we see that there is a great deal of the people that are not vaccinated that are causing potentially an increase in the infections, as basically the risk is still very much open here as we move into the summertime. The lumber market, just to go into the lumber market here, is still very quiet here at 605, and it's come down tremendously from the high that we saw of 1711 in that vicinity. We've seen more than a 50% drop, obviously. The bond market is pretty much quiet on the news, 127. And I think if you guys been watching these videos, and certainly my traders in my trading room here have been hearing me pretty much talk about the 10-year note more than any other time. And it's because we've seen an anomaly in the 10-year note that the market came down basically from about 177 into where it is right now, about 128. And now that we're getting this unemployment claims higher than expected, it seems that the bond market may be anticipating, again, some kind of a potential slowdown in the economy, some kind of a black swan event. It could be as a consequence, basically, of this pandemic, this variant, once again, that's increasing the infection rate in the United States, primarily for people that have not been vaccinated. So the resurgence of the virus could be devastating for the economy, particularly if we are forced to go into another lockdown. As it is right now, the economy is very fragile. It's flying on stimulus. It's not a real economy. It's being supported by the tremendous amount of repos that are being done in the market, 120 billion a month, in addition to some other measures that are being taken, I believe, in the short term end of the curve, which are essentially responsible for bringing down this tremendous rates to where they are right now, in spite of the opposite, so to speak, argument that going into some kind of an inflationary, event, more or less, is going to force the Feds to act sooner than later in terms of tapering or raising interest rates. And so this is what the confusion seems to be right now in the markets, that are we in a highly inflationary rate, or is this just a temporary inflationary rate? I think that question has to be defined depending on what kind of a time frame you're looking at. I think short term, the markets are realizing, or the interest rate markets, or the bond markets basically are realizing that rates cannot go higher at this point. And so the government monetary policies that are being implemented right now are very dovish. They're basically taking the path of least resistance, and that is basically to continue to maintain the economy with the stimulus necessary to maintain these markets afloat. And that's exactly what they are. They are floating, but they have committed to print as much money as it needs, and therefore we have, about a 30% increase in the money supply, and we're dealing with a tremendous amount of cash, fiat currency, across the board, as a consequence of this stimulus. And so obviously, with the potential of getting back into some kind of a normal economy, it was expected to think that we're going to see economic recovery, and potentially explosive economic recovery. As it is right now, obviously this economic recovery that we're entering to initially is showing already some signs of stress in the supply chain. I'm hearing stories from my traders where they live, particularly in Texas, that some restaurants are closing down. They have raised the price of beef 200-300%. And so meat is very expensive. Everything across the board seems to be just exploding in prices. On the other side of the coin, the statistics show that we are approaching, because of higher prices, a level of consumer resistance. And I keep saying, the best cure for higher prices is higher prices, because it creates consumer resistance. And it doesn't matter how much you want to charge. If I don't want to buy, that's the end of the story. And I think that's the kind of attitude that we're beginning to see in some of this consensus coming out regarding consumer spending from the University of Michigan data that came out. And if you take a look at a video a couple of days ago, I used some of the data that indicates basically, again, that the bond market yields are coming down, and that the bond market may be expecting some kind of a slowdown in the economy. Um, so we're dealing now with the fact that unemployment claims are up higher than expected. And it's going to be interesting to see once again as we come into the next FOMC meeting what kind of monetary policy or what kind of monetary talk they're going to have. Are we going to be talking continuing tapering possibly sooner than later, or we're going to stay status quo and potentially reverse the path of higher interest rates to lower interest rates, which will be the surprise to the markets. And it would be extremely bullish, basically, for commodities, once again, for all this inflationary assets that collapsed on the rhetoric of Chairman Powell, tapering. The markets across the board pretty much collapsed. And so I think what we're going to see is a reinflation of these markets. They have a lot of room now to run, to catch up to the upside after this correction. And when you really think about the fact that the path of least resistance, the bond market is directing is downward in yield to go down. The pressure on the 10-year note is for yields to go down. And so, it's right now, obviously contrary to the sentiment that's out there. But this is what the market is saying here. And I'm pointing out to you, the facts of what the market is saying. So what I believe here is happening here once the market realizes that interest rates are not going to go up, but instead they may have to come down even lower, potentially to deeper negative interest rates now, factoring in this so-called inflation. I want to point out to you that Shadow Stats with regards to inflation is running some numbers that are astronomical in regards to the inflation rate. They're running an inflation rate of 13.4%. The unemployment that they are running, which includes everybody that is unemployed or can't find a job or has given up, is about 25%. So, what you're seeing on the CPI right now at 5.3, roughly, I believe, with an inflation rate, I believe we're running at about 3.5% according to their calculations. We are getting into deep territory, negative territory, factor in inflation on, real returns. So the money is looking for alternatives, which is what you're finding in the digital currency markets, which is it's an indication of the money looking for alternatives in terms of finding value outside of the US dollar. Not only outside of the US dollar as a fiat currency, but outside of the centralized banking system. And so Bitcoin is definitely in the map, being discussed a great deal by everybody on the planet. And there seems to be some major projects being developed, funds that are coming out, that have come out already for Bitcoin, like GBTC, which is what we trade, and GDLC, which is the Bitcoin Grayscale digital fund. Um, so the money is looking for alternatives in digital currencies. Digital assets have become very, very popular. They have become assets, you know, um, digital assets, and they're all a market on their own with tremendous, tremendous volatility, which is what I believe the virtual currency market is doing, is changing the benchmark of volatility in the markets. You're beginning to see, moves of 20, 30% in a day that most of the time conservative traders in stocks or other passive instruments are not used to seeing that. If you're a futures trader or an options trader, you might be used to that kind of volatility. But if you are like most investors or traders, this is highly, highly irregular volatility. So we're getting a signal here in Bitcoin on the long side. And the target is 33,853. Bear with me here. I'm checking out some prices here. We've activated a buy signal from the buy one level here, which is really the highest probability for you to enter or trade when the area blue. You take a look here, make sure that we're looking at the daily numbers here. The signal was on the weekly trigger point. This is the weekly signal that we're getting on Bitcoin to go long. If you have a conservative stop that you're looking for, you can use a close below 31,752. The target is 33,853 right away. So coming back here to the algorithm here, you can see that the algorithm is basically like a GPS that you can use to guide your trading. The daily signal is trading above the average. So it is confirming that we have a bullish price momentum. And when you're trading off the mean, basically, which the AI suggests that it is a choppy area, it's a 50-50 standard deviation, and therefore, as a trader, it tells you basically the highest probability trades is at the extreme above the mean, which is the sell one level, or at the extreme below the mean, which is the buy one level. The average has a 50-50 standard deviation. So that means that it can go either way. And as a trader, what I look for is the highest probability trades. And that's what I suggest my traders to do using the VCPMI. And that's essentially when the market will go up either to, once again, 33.28, complete this bullish pattern, and then we'll see what the market wants to do from there. But usually you get a reversion, you get an opportunity to sell short, or supply comes into the market here, and it's a question of how much supply that will determine how deep the short signal could be. But this is the highest probability trade. To sell and to buy would be the buy one level, which would be the extreme below the mean. Right now, the market is in an uptrend, a bullish price momentum. And once again, the target is 33.58. Coming back to the gold market, which is the other alternative that we look at when it comes to basically using instruments, alternative instruments than the US dollar. Whenever you buy gold, or whenever you buy a Bitcoin or digital assets, you're selling your dollars against that. You're converting your fiat currency to those instruments. And when you're trading instruments in gold and silver, you are trading money instruments. They are considered paper markets, and therefore, you do benefit by the appreciation of the fiat currency value in that instrument, pertaining to relative to the gold market, relative to the silver market, which in my opinion are real currencies, as opposed to the fiat currency that obviously is losing its value, it's losing its intrinsic purchasing power, every day as they continue to print this stimulus. So we have another $3.5 trillion come in, so far for that's waiting to be approved for infrastructure. So what's 5 trillion here, 5 trillion there? We can print as much as we can, and it really is, I believe, entering an area, a level that could be very dangerous for the US dollar. What we don't want is for the US dollar to lose its reserve currency factor, you might say, or control, as the world's leading currency. But we don't want to deplete, you might say, the integrity and credit ratings of the U.S. bond market. Because it would cause a tremendous downgrade in ratings, and we don't want that to happen to the world's reserve currency, is to be downgraded. That is the last thing that we want. So in the meantime, the Feds will continue to print as much money as the market needs until such time something breaks. If it's not broken, why fix it? And this is the kind of philosophy that the government is in right now. And I think it's not just the U.S. We're looking at the central banks on a global basis are taking this attitude of stimulus, supplying stimulus to the market, and expect some kind of an economic recovery. It's a big argument between Austrian economics and Keynesian economics, and for those that simply want to follow that logic or understand that logic, great, good luck. For me, it's a question of coming here every day using the VCPMI, looking for trading opportunities, and using the volatility of the market to give me that opportunity, because things can change, and nobody really knows. As you can see, what happened here last year. Nobody expected this, that we'd be in this place, that we would have the worst pandemic in 100 years, and the economic system will collapse, and pretty much the Feds will come in and print all of this incredible amount of money that we have in the market. All you got to do is take a look at the M2, showing over $8 trillion of money and savings, and people not only are flooded with the stimulus money, but are sitting on tremendous equity built into some of these bubbles. Just think about the equity built into the real estate market. And so interest rates cannot go up. The minute that interest rates show a sign of reverting, look out below. Look out below. So how long can they continue to produce fiat currency and expect some kind of an economic recovery is questionable to me as a trader. So coming back here to precious metals once again, although it's been very frustrating for most of us because the fundamentals dictate that the prices should be a lot higher, than where they are right now. And so what we can see, obviously, is the money went to digital currencies. It went to Bitcoin. It went to GBTC. And it went to digital assets that are decentralized and are part of this incredible blockchain mechanism that makes it possible to be decentralized. And that is pretty much the latest, newest invention, I would say, of mankind in the monetary system that is definitely taking the attention. It's taken my attention, obviously, as a tradable asset. It has all of the ingredients in terms of being able to trade it. But the argument and the philosophy of whether it's going to replace gold or it's going to be the new currency, it remains to be seen. And even, I believe Honduras, I believe, or El Salvador, monetizing their currency into Bitcoin, it remains to be seen, what the process is in the monetary system of Bitcoin, or how it can be part of that monetary system. A lot of uncertainties, a lot of volatility in the market. It's great for trading. And basically, I think just to kind of review here, the fact that interest rates are coming down is anticipating a slowdown in the economy, and interest rates coming down is going to surprise a lot of traders, particularly the markets that collapsed that were inflationary markets. I think what this could do is reinflate those markets, and not only reinflate them, but cause them to move at a faster pace, realizing that interest rates are going down and possibly making new highs into the summertime. We're looking at the 360-day cycle in gold, projecting 2150 into the summer months. We'll see. We'll see. And we'll review this video hopefully by then and see what the VCPMI, how accurate it was. But in the meantime, continue to join me every morning here at 7 a.m. Please subscribe, like, and I will continue to provide you with this amazing artificial intelligence. Have a great trading day, and I'll talk to you real soon. Talk to you later. Take care.